Ah, wow. Just had the perfect angle and I ran right into it. Let me just. Yes, better. Perfect. Alright, perfect. Alright, welcome back, guys. Welcome to another video or another live stream. I'd be tripping. It's in the live stream. Today is what? November 11th, 2025. News for today. Today is Tuesday, so we have Veterans Day, bank holiday, so there's not going to be a lot of liquidity in the markets. Not to say that there won't be a potential trading opportunity, but I'm not going to trade today. Since there's not going to be a lot of liquidity, and I'm just not going to take the odds. The odds of trading on holidays are not the best, so I just stay out of those. But I am going to analyze, and I'm going to work on what I have to work on. And what I'm actually working on today is the discipline to not trade on bank holidays. Not only the discipline to not trade on days that I don't have trades, but not trading on holidays. Next is going to be discipline not to be trading on NFP or high impact news days like that just could cause a lot of slippage. Those are important too. I still think I'm in the realm of still think I'm gonna be in the realm of what would I say? I'm in the realm of probably lowering my leverage. I don't think I'm at that level yet where I'm not gonna trade those days, because those are like the best days. And then sometimes the odds fall in your favor and you just have a big trade. But last time I did lose $2,000, so that wasn't cute. But I do want to figure out. I want to figure out the range of yesterday's range, so I could just go ahead and put it in my information. I didn't say yesterday we no, that's not accurate. Alright, so that's today right here. The yesterday would be over here. Yesterday we have, let's open the calculator. Yesterday's high was at 1.18 784 minus 1.17. Moving the mouse. Sorry, guys. My bad. Alright. I gotta do this again. Yesterday's high was at 1.15 831 minus 1.15 411. And 42 pips. We got 10 times by 10,000. 42 pips. Yesterday. Yeah, out of 10. 42 pips, surprisingly. It looks smaller than that. Let me go check. 10, 20, 30. Huh. Just look at that. It's still a 1, 2, 3 to 1. To 1 at 42 pips. I guess if this is 10, 20, 30, this is probably going to be like 8 pips. And this is going to be, what, like 5 pips? There you go. Surprisingly. Alright. So we're gonna do the same process. Let's go ahead and get one of these. First I need to know what level coordinates it at. 15751. Oh no, I need one of these. 651551. Okay. This is easy to grab, so let me grab that and just drag that over here. It's not even at all. I knew I was off by like a pip. L plus 1. Let's clone that because we did go a little bit higher. L plus 2. Alright. And then let's do one more for L3. Change this to red. Four, 5, 1. 4, 5, 1. L negative 1. And we haven't have a strike here yet, so we can just leave that like that. And then we can go ahead and identify each hour. We held the level 0. We held the level again. We've been holding this level for a while, guys. Like I told you, like sometimes it go like 8 or more hours where I hold the level. Since we had a holiday, probably definitely happened. Uh-oh, I'm bad. Man. See how many hours that is so far, guys. 1, 2, 3, 4, 5, 6 hours where we held the level. So that is 5, 6, 7, 8, 9, 10. And PM, that's what I'm going to say, 10 PM. This is going to be 11 PM. We held the level again, and we almost we We almost touched the bullish level, but we've turned it back around. Almost don't count unless it's trading. Then if I'm going to have a TP, it's probably about a pip lower. But when it comes to analysis, don't count. We held the level even more. Very typical of a holiday for us to hold levels for 8 hours or more. So how much you got? 1, 2, 3, 4, 5, 6, 7, 8, 9 hours. After the 8th hour, I'll be expecting a move. Even though it kind of did a move, it just pivoted like at a half a pip away. 11. Oh. 10. Now we finally hit bullish level 1. It took us a while. And what's happened here? Project the next 10 pips. Change this green. I guess the momentum is going bullish. Clone this here. This is our next level. Between levels L+1 and L+2. Oh, no, I can't really do that. I have to go. We actually retested. We went right back down after going bullish. So this is actually a reset. Still a hold, but we did push bullish. And then we went back bullish. In 2 minutes we're going to have our 8 a.m. candle printed. I'm gonna dramatize the trade, but I'm not gonna take the trade. I think it's gonna sell off back to the I think it's gonna sell off back to the weekly open price, and we're gonna have majority of our move happen. Let's make sure we didn't touch. I think we're gonna have majority of our move happen Wednesday, Thursday, Friday. Hopefully there are some moves in there for me. All right. So fortunate. No. This is not. This is a hold. There you go. And we went bullish here. So now we go ahead and project the next level here. Change this bullish. Ew. Change that bullish like that. And come over here some. And we kind of open 5-minute chart has updated to 1.15707. I'm not trading today, so I don't have any trades to place. We're just gonna watch markets move. We didn't move anywhere, so we're gonna have to do like this. Means we held the level. And then next, what I'm gonna do here is I'm going to go ahead and project my trading range that I would have used, but since I don't have, since it's a holiday, I'm not gonna trade today. But I'll just draw out the trading session still. So from 8 a.m. to 12 p.m. is where my trading window. It can be a little bit bigger than that. It can go up to 5 p.m. depending on the type of trade, but for the most part, that's where it's at. And it looked like we actually, no, we didn't. We actually closed like in between the levels, so that's that. All right, so what did I say the 8 a.m. candle open price was? 8 a.m. candle open price was 1.15707. So I'm gonna go ahead and grab me a line tool, draw it straight across. I want this line to be black to represent the 8 a.m. candle open price. We're gonna name the line 1.15. Okay, 15. It only took about 1 minute and 40 seconds for price to actually indicate direction. Usually on days with usually on days with no news or days with news, it never moves 5 pips in less than 2 minutes. And look at that, a day with a bank holiday where it's supposed to have low liquidity, it actually put in an indication of direction in record time. So that's interesting, but not gonna move me to get into any trade. 1.15707. I think I'm pretty close. 7 here, and then we're going to project the bullish indicator, which was just hit by that little alert that you heard there. Change this to blue, make this a dashed line, and then we're gonna do 1.15707 plus 5 pips is gonna be 1.1557. Paste that there. That's gonna be our bullish indicator, which we did hit, to represent that the bias for the trading session is gonna be bullish for today. And then we can do this to represent our bearish line. We just gotta do 657. Let's try to do 657. 657. That's gonna be our bearish indicator, which is not gonna be strike, but this is also gonna be like, since we are bullish in our indication, if we would have got into a trade on any other given day, when markets come down to this price, this is where we're actually gonna buy at, giving us an extra 10 pips of range, giving us a better stop loss away from a level, the first 10 pips below the 8 a.m. candle open price, and giving us a better risk reward ratio. And then what we're gonna do next is we're gonna go ahead and do that and project the next 2 bullish and bearish levels. 807. Paste. There we go. 807. I could use something else. The next one would be 907. And that's gonna be the second bullish level above the 8 a.m. candle open price. That's the end of that range we'll be looking for. Now we can do 2 bearish ones. Oh, it did work. Turn this red, turn the text red. If that's 507, we're gonna do that 607. And that's the first one, and one more. 507. And paste that there, and boom. So that's our trading range. We got our 8 a.m. candle open price. We got our bullish and bearish indicators. We got our, let me change the color to this one so a brighter green so it could stand out. We got both of our bullish levels, bullish level 1 and bullish level 2, to indicate 10 and 20 pips above the 8 a.m. candle open price. And the end of the range, usually we're going to be looking for markets to continue past, either levels if they were hit, and then trail our stop loss behind price every 15 to 10 pips, depending on how tight you want to have it. It's up to you. So we get this is our 4-hour range. We're gonna let price fluctuate within that range. But technically speaking, we are done analyzing. I could go and get one of these labels right here to label this day 2. I don't know what the risk reward is, and I don't know what the pips are. And then we could go and move it over. This one is deceptive, so that means that by default you're a deceptive person. Can't mess with that. Don't trust you. Alright, now I'm just gonna start working on some stuff, guys, after this. We're gonna let price do what it do. I'll explain what's happening, but like I said, we're not in any given trade for today. Let's get back in the mindset. Alright, Magnet Mobile Trading Solutions. I can go over, if y'all want, I could read this to you guys while I'm looking over it. Probably don't need to be that big, huh? Chart, we can look at this. Alright. Alright, let's have a little lesson. Alright. Do you want to know the truth? Take the blue pill, keep scrolling, and stay in the dream, chasing money, lavish vacations, cars, and the social media influencer lifestyle. Or you can take the red pill, stop, and learn how markets actually work. Study time and price, follow the data, pursue the skill, and master technical analysis and trading the right way. The choice is yours. Next slide. So here's the truth. Trading is an optical illusion. We all have the same data, price, and time. But how you perceive and interpret it is the trap. If you are fixated on making money, winning trades, and what trading can do for you, you will fall into the psycho-emotional traps like most traders. While you are trading price action, it will feel like price action is trading you. I'm sure a lot of you have felt that way. So whether you know how to trade or you don't know how to trade, unless you can read and trade non-subjectively without emotion, you will sooner or later fail. So basically what this slide is saying, or let's go back to the first slide because I didn't get it. So basically what the first slide is saying is we all as traders, or as retail traders wanting to get into trading, you're already in trading, whatever level that you're in. If you're not successful, if you're not profitable, if you're not consistently profitable, you could take one or two pills. The first pill is what a majority of people are taking, or the retail people, the people that aren't consistently profitable, the people that are going to assist in the system, they take the blue pill. Because what they're doing is they're focusing on the dream that people are selling them online, the dream of the money, all the money that they're making, big account flips, $100 to $1 million or whatever, flashing money, showing you their trades, whether they're open equity or closed trades without giving you perspective into their trade history, if it's a real account or not, their methodology, how to get in and out of trades, explaining it to you, not just showing you a screenshot, because you never know where a screenshot comes from, right? Lavish vacations, they're always in a different country, they're always spending money in a different country. I know you see the YouTube videos, 100,000 in Bali, 50,000 in Asia, and all these other what they call those titles, clickbait titles. The cars. Every video an influencer is in another car. Like it doesn't matter. Let's call them course sellers now, or whatever you want to call them. Every video they're in another car. I actually started feeling sad for them because I understand analytics. I understand how they looking at each video when they post videos of their lifestyle, when they post videos of them actually explaining the reality of their everyday life, when they post videos of, just them in front of a camera, opposed to when they post videos of them buying a new car, spending $100,000, $200,000, $500,000, $1 million, multi-million dollars on one car to post a video, and that video is going to increase their sales for the course that they're selling. And a lot of these people, especially if you live in America, you have credit. If you have a business, you already have credit. It doesn't matter how bad your credit is. Once you start having your course business going, your credit is going to go up. So they're not buying these cars. I believe not until you live in a country outside of America that you understand that when people say, I bought a house, or I bought a car, or I bought a boat, or whatever like that, in America, they don't buy things. They put things on lease. They put things on what they call payments, finance these things, and then the bank buys it, and they pay the bank a portion of it on a monthly basis. They could get in and out of cars with the same equity or the same debt. So they never put all of the money up front for the vehicle, and they can keep switching and hopping in vehicles and have this floating debt around as long as they have as long as they continue supporting that lifestyle with selling more courses, so on, etc. They could keep up that thing, but that it never lasts long, right? Because the other stuff that they buy, which is a lot of depreciating assets like jewelry, clothes, spending money, lots of money on vacation, clubbing, their lifestyle is gonna deplete their money faster. And those are the things that they cannot physically hold anymore when the course goes down, when social media is no longer on their side, so on, etc. As you can see, Marcus is heading to bullish level 1. So it is rallying, and it had a little to no drawdown. All right. And then the red pill is the true traders, the trader that isn't cool, the nerd, the analyst, the engineer, the one that has a college degree, the one that isn't as cool, wasn't so socially awkward, and likes anime, kind of quirky, kind of weird, but they're the ones they'd rather not show you their account size because that's private to them, because that they're really actually making this money. And it's like showing random strangers your open bank account. The thought of doing that to a average person or a regular person that's not social media based is absurd. You get what I'm saying? You're showing random strangers, including the government and IRS, your account, your money that you actually have, the money that you actually own, which is, it literally should be absurd. You get what I'm saying? And it's an invasion of your own privacy that you're doing voluntarily. But I understand that's how you get your money, that's how you get your business, so on, etc. But when you start seeing properly and seeing clearly, you understand that those are the people that actually they are real technical analysts. They are financial analysts. They do study price. They do study time, or whatever methodology that they study. You understand that they're bookworms. They actually study this stuff and they actually know it. And they're more data driven than the glitz and glamour. You get what I'm saying? They're more information driven than everything that has to do with everything that's not on the charts. And they have less. The crazy thing is even though they may have less of a following, or they might not be as popular as whatever, sometimes they do blow up because, like, sometimes money, you can't hide it. Success, you can't really hide it. Whether you try to live a simple lifestyle or not, sometimes it comes out, right? But whether or not they do that, the quality of their customers or the quality of their students, or the quality of people in their community is a lot better than the quality of the people of the community of the blue pill, where they're showing off the lifestyle. Those people, first of all, a lot of them are professional people. They have families, they're married, or they're just like reserved people. They're smarter. You get what I'm saying? They're more intelligent. You get what I'm saying? And then their community is quality people. So you don't need 100,000 followers, 1,000,000 followers, or whatever. You can have 1,000 followers. You can have less than 1,000 followers of quality people. Sometimes it's actually, you can have 1 or 2 billionaires within your circle, and y'all can make all the money in the world. You don't need all. When you start having 1,000,000 followers, 10,000 followers, they're not all there for trading. They're there to either watch your success or watch you fail, or watch you do debauchery, whatever it is, or live vicariously through your lifestyle, parasocially, be parasocial friends with you, or whatever the new words that they use for the day, right? They have all these followers and all these people. The people that are in their course are not in the course because they wanted to learn how to trade. In their mind, you call it popcorn brain, right? Goldfish memory, TikTok brains, where in their mind, if you catch them and they actually pay for your course, they think just because they pay for the course, that automatically would make them successful. They don't think that, okay, I'm going to pay for the course, that's for the information, and I'm going to put in the time, work necessary to learn the skill and execute the skill, and also learn outside of the course in terms of psychology, discipline, finding your own personal style of trading with the course that you have. That's maybe like the blueprint, but you will find your own way amongst that, and you might elevate past the teacher, or you might go in your own direction, your own lane, or you find your own niche and you stick within that. That's what happens with the people that take the red pill, that actually are data driven, information driven. The people in the blue pill, they're not passing the course. They are not finishing the course. They're not dedicated to it. They're complaining about not having money. They already have the wrong mindset. It doesn't matter what you tell them. You could baby them into the trade. You could give them signals. You could have an EA execute the trades for them. They will eventually blow all the money because they don't have the right mindset. They don't have the experience. And they don't have the discipline that is necessary to be traded. That's why trading is, I believe, it's all fair. It's a zero-sum game, but it's fair at the end of the day. It's not going to let you skip the line. It's not going to let you hop and pass. It doesn't matter how much money you give somebody. Unless you have an EA that's just like an immaculate EA, or you are investing in somebody that trades for you, a capital manager, or whatever. Different ways. Even though to even think of stuff like that, or to even be able to filter and get the right information like that, if you're not lucky and somebody put you on, is you still one of those quality people that are actually taking the red pill. So that's why I put the first slide there. I like the little matrix theme, and which is reality of the fact that the choice is yours. You could either take the blue pill and either continue scrolling, or you chase the money, or you could take the red pill and you study the data. You fall in love with trading. You fall in love with technical analysis and the process, and then the money will come. Okay, and then I already read this slide, but let's go over the slide again, which is trading is an optical illusion. And what I mean by trading is an optical illusion is that what's on the charts here is just price and time. They give you number on the, what you call it, it's the y-axis, price, and then you time on the x-axis, if that's how it goes, right? So we just touched, almost touched. You'll hear the indicator go off, but when we hit that first level, we're on the first bullish level, which means that a price may continue to go to the next bullish level, or it might reverse and fluctuate around, or whatever. We'll talk about it when it happens. There you go. Let me see if we can catch it. There you go. My computer has sent, you can hear the notification on my computer, but also sent a notification to my phone to let me know that, okay, the price has touched the bullish level. Now let's dramatize. Like if I was in the trade, I will still be waiting for price to come back down 10 pips to hit. It's more than 10 pips now. Price to come down 10, 15 pips to go ahead and put me into a buy position, just to say that price is going to fluctuate, pivot about 10 pips more of margin of error, pivot back up, and then continue in the bullish direction. So the first 5 pips, it let me know the direction as the market is going to go in. But then I have about like another 5 to 9 pips of market fluctuations to allow it to continue going bullish, then drop back down and enter me into a buy, and then pivot back up to let me go into that bullish trade. But it also has a right not to come back down and continue just rallying up, or whatever it wants to do. But I just pick what is best for me, which I notice that happens within my trading range, that give me a the best risk reward, that gives me the best stop loss to filter losing trades out. Now back to the slide is trading is an optical illusion. So what I mean by that, we all have the same price and time on the data. We basically all have the same data charts, but the way you perceive the data is what is enabling you to make money or not make money in the markets, because of what you're, like I said, back to the first slide, what your mindset is fixated on. Are you there to make money, or are you there for or are you there to learn and master a skill? This is a beautiful move to the upside, as you can see. If markets touch this next bullish level, in theory, if I was in a trade, that would invalidate my trade for the day, because it officially means that markets was moving without me, right? So let's watch it. So, okay, the way you perceive it is the trap, and if you're fixated on money and winning trades, you'll fall into the psycho-emotional traps, right? What I mean by psycho-emotional is your psychology is attached to your emotions. And based on the reason why you're getting into the trade, to pay your rent, to get rich, to flex on the gram, to help your parent that have cancer, I call it salvation. Making money in trading is your salvation. It could psychologically, the data on the charts could psychologically manipulate you to think, to see, and to do things that isn't rational. Or that it's just numbers on the charts. Numbers on the charts should not be able to move you as a human being. But because of your mindset, it has the ability to do it. But at the end of the day, this is just digital numbers on a chart, on a computer, and you're just clicking buttons. But its ability to trigger your psycho-emotion, your psychology and your emotion, if you allow it, is bigger than God for certain people. They believe in trading, and trading can move you more than God, more than your boss, more than your parents, more than your wife, more than real things that are in reality. This isn't reality. This is a dramatization of what prices are actually doing. God knows if this is a FTMO chart. God knows that this is actual Euro USD data. It's as accurate as it could give it. But if I go on TradingView, it's off by a few micro pips or a pip or whatever, right? So that, okay, back to this. All right, while you're trading price action, it feels like price action trading you. So if you have traded before, you will notice that when you're trading, it feels like markets is directly hitting your stop loss. It's like you feel that when I got into this trade, it's like the markets know where my stop loss is. There is another thought process I can go on where the broker does know where your stop loss is, and they can do that. And then there's another layer on top of that where banks, institutions, and big money, smart money, they actually understand that you have crowd psychology, you have crowd information. So off baby pips and free information that you get on the internet is gonna, if everybody is using that same free information, everybody's trading the same way. If everybody's trading the same way, everybody has the same stop loss. If everybody has the same stop loss, if for somebody that's moving the market needs liquidity, they will know based off of support and resistance and different factors where your stop loss is. As you can see, we are rallying. So when we rally like this, I'm not gonna get into a trade because this it's hard for me to really explain it because I explain multiple things at a time. But once we touch that level right there, you got the indicator. The indicator went off on my computer, as you can hear, but it also sent a notification on my phone saying the secondary level has been touched. I'm out of my bullish position is invalidated because markets is rallying way faster than I can expect it to come back down and enter me into a buy position, or the most ideal buy position for me. Now, because I understand that markets on Euro USD move an average minimum of 20 pips per day, if markets has moved from the 8 AM candle open price, markets have officially moved 20 pips. I cannot expect on average, not on this specific day could go a billion pips, it doesn't matter, but on average, I can't expect the trading session or for the trading day to go beyond 20 pips. That means that the move is already done. I've missed the move already. So that's why I invalidate my trade. But in a different theoretical setting, which because I've taken every single trade before, and I know how every single trade moves. I know how every winning trade moves in different variations of winning trades. If I would have placed a buy position with a 5-pip stop loss, I would have been at like about a 3-1 right now. But I understand that markets do not always rally like this. There are going to be times, there are going to be cycles where markets rally like this, but on if you're thinking of probabilities on a probabilistic basis or across a year of data, markets is not going to move like this. It looks amazing. It's going to make you think that, okay, because market's moving like this today, it might move like that. Oh, Jesus Christ. Tomorrow or for the rest of the week. Now, I'm also going to state another fact, which today is a bank holiday. Every day since the past few days, markets has not rallied like this. You get what I'm saying? This is what's going to call like a phenomenon. This is going to, if you don't have the right mindset, make you believe that the next holiday markets might move like this. It very well might. But on a probabilistic basis across a series of trades, a minimum of a year's worth of trades, markets will not move like this. But you have to be able to think in probabilities and not think in just one individual trade that's what 10 to 100 trades are going to look like. So that's a move. Let that move do what it do. Since it's a high day, I didn't trade today, and that is what it is. What is good for me is that it didn't do the scenario that I wanted to, where it went bullish, it came back down, hit my entry, and went bullish again. Because it didn't happen today and it didn't happen yesterday, the probability of it happening in the future is more probable. But every day is an individual set of probabilities, so on, etc. So I don't want to get stuck on that, but the trade is invalidated for the day. Market's moving bullish. You can see it for yourself. Back to the slide here. All right. So okay. So whether you know how to trade or you don't know how to trade, and you know how to read the markets, you don't know how to read the markets, unless you could do it non-subjectively without emotion, you will sooner or later fail. When I say sooner or later fail, I mean that sometimes you could not know how to trade, or you can know how to trade and you can make money. You can make a lot of money. You can make a lot of money for a while at that. You get what I'm saying? You can have a good run. You got beginner's luck. You could get into a winning streak. You could flip. You get the right time and the right money that you had to risk and the right trade you had would have had your account jumping. But time never fails. Time always tells. So sooner or later you will fail. Though you're making money, you have not developed the skills of a consistently profitable trader. Though every single trade you're taking is profitable, does not mean that you had the knowledge and the experience to predict that it was a profitable trade, as well as manage it as a profitable trade, or repeat that process when you're losing. So the same process and the same thought and the same executions and why you get into the market, where you get out the markets, and the emotion that you have to have has to be the same with winning and losing trades. Because you're winning and you didn't know how you won, or just the odds were in your favor at that time and you made a lot of money, whether you withdrew the money, you started a whole lifestyle and everything like that, sooner or later time is going to tell if you can make that, if you can stay consistently profitable. Not to say that you can't make money. Sometimes people get lucky and they start making money via courses, and they start making money via all these other things, and they have a stream of income that, even though they're not the person that they are, they have a buffer where they continue lose, but they have a course to make their money lose enough, and then it's different ways that they do it. But not until sooner or later you'll fail, and then you'll blow their account. It doesn't matter if you're up $1 million, $10 million. You're gonna risk $5 million, $15 million, and you're gonna lose. That's why people that win the lottery, majority of people win the lottery, end up broke. Millionaires that you see either in entertainment or different fields where they didn't have to actually be smart, they end up broke because they don't have a millionaire mindset. They don't have a billionaire mindset. They don't have a consistently profitable trader mindset. It's just situations were just in your favor at that time, and then when the time comes for you to be who you actually are, sooner or later you'll fail. All right, next slide. Next slide, finding trades. All right. So on this slide, it says verbatim, the problem isn't that you can't find a trade. These are for people that's not traders. The problem is that there's an infinite number of trades in front of you. So, theoretically speaking, there's a million ways to, there's 1,000 ways to skin a cat, right? So the problem isn't that the problem probably is that you can't find a trader. You don't know what a trade is and all that data information. But the problem is the core problem, or the larger problem at hand, is that there's an infinite number of not an infinite number of ways. There's an infinite number of reasons to get into a market. There's an infinite number of ways that you could set up a trade, or that your trade idea could be conjured up. That's the problem. What you need is, unless you know what you're looking for and how to find it, you'll stay trapped, hopping from system to system, trading anything that moves. So if there's an infinite ways, if there's 1,000 ways to skin a cat, and there's so many ways to enter into the markets, what you need to do for yourself is find out what you're looking for, what trade you're looking for, how you're going to get into the trade, how you're going to get out of the trade, how you're going to manage your emotions before, during, and after the trade, and following a system that you have back tested, that you believe in, that you have proven yourself to work. If you don't do that, you're gonna end up be what they call it, trading, looking for the golden bullet, the 100% win rate strategy that you press a button and you're gonna make money. Or you're just gonna be trading anything that moves. So anytime the market makes a big bullish move up, you'll buy. Like if you would have seen that bullish move, I know my younger version of myself, whenever I see markets move like that, I was like, I can't miss out on the trade. That trade's showing me the direction, buy. And then what happens, it stops after a while, then it starts retracing, then you start thinking, I might be wrong. Yeah, I missed the move, sell. And then it goes back bullish, and it just whipsaws you out, and you lose, and you fall into the psycho-emotional trap, right? So Magnum Opus Trading Solutions, which is why I like the name solutions. I'm looking for solutions to these problems. Offers a grid that any chart expressed by time and price. Let me read that again. Magnum Opus Trading Solutions offers a grid that filters any chart by time and price to allow you to perceive price action as it is. How you perceive it is up to you. The grid presents price action as how it is. As you can see, that's the MOTS grid. I have previous videos, parts 1 through I think 5 on my TikTok. You watch that, and I explain the MOTS grid and forms of analysis. In this video, I'm going to be more geared towards trading. All right. I like this slide. The one, you know how Neo is the one, and then Neo spelled a different way is Neo. The one is ONE. Same thing, right? So it's not what you see, it's what you don't see that matters. I did not say parts 1 through 5 explain this in detail, but the framework of price and time is what's truly important. So this is the framework of price and time. The hour is the building block of every trading day, week, month, and year. So the trading hour is, I would say, in my opinion, especially as a day trader, is going to be the building block for every day, week, month, or year. Let me finish it off, right? Each scalp, day trade, swing, and investment happens at a specific point in time inside an hour. Think about it. All right. So when I say the hour is the building block, when you look at hourly candles, an hourly candle, for me, I have to put it in. I want to put it more in perspective. When you look on hourly chart, when you look on the 5-minute charts, but you're analyzing hourly candles over days and weeks, which is why I use the 5-minute charts, and I put the Magnum Opus grid, and I highlight the hours, then I highlight the day, and I highlight the overall week. It's just the building block. It's like the atom to the entire trading thought process and methodology, right? The hour is just so perfect. It can be broken down into 15 minute, 5 minute, 1 minute, even lower. And it could be used, and it is the building blocks, or literally the concrete structures, the blocks that you use to build a day. There's 24 hours within a day to build a week. There is 120 hours in a week. There's 4 weeks in a month. There's 12 months in a year, and they all can be broken down, and it all can be broken right back down to this 1 hour, or built off of this 1 hour framework right here. And then, like I said, every scalp, every day trade, every swing trade, every investment happens at a specific point in time inside an hour. Think about it. When you place a trade, what time do you think about timestamps? What time do you place a trade? You end up placing the trade 1 a.m., 2 a.m., 3 a.m., 4 p.m., 5 p.m., 6 p.m. You get what I'm saying? If you look at it, it's always a timestamp quoted in hours and minutes. What hour of the day, what minute of the day, what second of the day, whatever it is. If you place a trade, if you enter into position, you could pinpoint the day, you could pinpoint the minute, the second, but most importantly, you could pinpoint the hour. There's always going to be an hour within the trade, right? And it's going to be the best way to express price action, in my opinion. Let me get some water right here, because I'm going to get parched in the mouth. Ugh. Good luck. All right, let's go. Next is the Japanese candle. Let me speak about the one right first, before it's a Japanese candle. So the hour is, the time is gonna be what do we call that? The x-axis, right? The time's the x-axis. You got the beginning of the hour and you got the end of the hour. That's gonna be the left side of the rectangle and then the right side of the rectangle. So you got to start, stop, beginning of the hour, end of the hour, 60 minutes, and then you have price, which is going to be the highest and the low, the high and the low as price fluctuates throughout the hour, right? These are the two most important and probably the only things that you need to study. I think volume is the closest third, or volatility or order flow, which is the amount of the transactions happening or whatever like that. But that, once you throw that in the mix, that would bring the analysis to a level of technicality that I'm not at right now, honestly. But time and price really is all you really need, and probability, and you should be good. But as super confluence, I would say that my next level would be to incorporate different forms of data like order flow and stuff like that. But time and price, all you need. So let's hop into Japanese candlesticks, which is the way that I view price action expressed on charts in my preference when it comes to my mathematical view or analytical view of trading, right? So the Japanese candle, or Japanese candlesticks, as you may know them as, the components of an hourly candle, it could be whatever time frame, but remember I say the hourly is the main one that we're using. The components of an hourly candle are simple. You got the open, the close, the high, the low. The open is the price the candle opens at. So it could be whatever, depending on where it happens on the chart, what security that you're using, and what numbers express that. You got the open, that's the price that it begins. The close is the price the candle ends at the end of the period. It could close above or below the open. That will create the sentiment of the candle. And then you got the high, which is the highest point, but it's going to be from the open. Anything above the open will be a high. When markets move above the open as a high, but the highest point, which is referred to as the high, is going to be the highest point above the high, right? You got the low, which is anything from below the open, and then the lowest point is going to be the lowest point that it reached. I put the close not at any specific close of the candle body. It's just a dramatization. You know, the technical people, I know you're gonna get at me for that, and I definitely see it. And within that framework, price action is price action, the bullish and bearish movement that occurs within that time window. But that's not all. All right, that's my segue to the next slide. But let's talk about price action. So you got the main points. You got the open price and time, and you got the close price and time. These 2 points, because they are connected to a specific time, they're static. The price that they close at is dynamic, but the time that they occur is static. You got the high and the low. That's price action. That's dynamic. You can go as high as you want. You can. There's a situation where it doesn't go high at all. It doesn't move above the open at all. You can go as low as you want. And there's a situation where it doesn't go below the open at all. And then these high point, the highest point or the lowest point can happen at any point in time or any sequence within that hourly range. So at the end of the candle, you'll realize which one is the low, which one is the high. Okay, we hit the 1, 2, third bearish level. Marcus is moving. And then the low, it could be expressed as the high to the low, which is going to be a bearish candle. It could be expressed as the low to the high, which will be expressed as a bullish candle. I just really want to put the emphasis on the high and the low is dynamic. The highest point and lowest point can be at any point in time within that range. And then the actual price of the highest point and the lowest point could be at any point. It's the more dynamic part of the 4 components that we're looking at here. But that's not all the information there. And then you got price action, which is in between, which is the zigzag and wiggly wag that happens within that hour. So, like I said, you really gotta watch the previous videos to really get an understanding of this, but I'm gonna do a quick explanation or the reason why it's so important. So, historical data shows that candles vary endlessly in size and volatility, meaning that the size of the candle in pips, points, whatever you want to express them as, the size of that hour or the size of the volatility that happens within that hour could be whatever. It could be small, it could be large. It's relative to the charts and what's common within that chart. But it could be 1 pip, it could be 10 pips, it could be 100 pips, it could be 57, it could be 32. It could be whatever it wants to be, 37,000, whatever it wants to be. That could happen as long as it happens within that range. That's what it is, basically, right? And then volatility, which is not just the high, but the wiggle, the ups and downs, the bullish and bearish movements, and how it happened. Did the high come first? Did the low come first? Are there multiple highs and lows? Are there one high and or one low? So on and etc. How it occurs, the price action occurs, that is also dynamic, and it has an endless variety of ways that it can do it, right? Quote unquote endless. By defining what a valid move is across proportionate levels and anchoring it within a set time period, we create context. Let me turn off this fan. Turn it down. Alright, so what I mean by that, right, is that using the Madden Opus trading grid, like I said, since price is so dynamic in how it moves and how far it moves, I decided to track how it moves instead of trying to guess exactly, track and measure how it moves, instead of trying to define just the range, because the range is not enough data. So when markets, I have to use a framework, I have to use an example. So in my example, I always use Euro USD and how Euro USD works and how I studied it. So in Euro USD, for the example, every time markets move a distance of, if it range 10 pip, a range and a distance of are 2 different things. A range is from the highest to the lowest. A distance of is from point A to point B. So what happens is, and what confuses a lot of people is that, let's say this candle range is 19 pips, right? Or let's say 18 pips. Even though this candle's range could be 18 pips, it could stop 1 pip above this level and never cross 10 pips. It could stop 1 pip below this level and never cross 10 pips. So it never traveled a distance of 10 pips in either direction, but the range is greater than 10 pips. This is the This is the duality. What is the duality of markets, where it can move bullish and bearish. It could there's some distance traveled is probably less than 10 pips, but the range is more. And the fluctuations in itself, if you measure and add up all the bullish and bearish moves indiscriminately of a negative or positive charge, can be more than a 10 pips, right? So that's how markets could move so tight within a range over a day or over a week. It didn't move at all, but it quote unquote didn't move, but it actually did move. It actually rapidly moved up and down in a tight range. But if you took all of that up and down movement and you stack them up together, which creates a distance traveled, it could be 100, 1,000 pips. But because the markets move bullish and bearish, it adds and subtracts, it could stay within a tight coiled range, which we call consolidation. So to help filter it out and to help track bullish and bearish moves, when they occur, the sequence that they occur, when price travels a distance of 10 or more, or a distance of 10 pips and subsequent 10 pips, I strike those off with a dot. So if it moves lower 10 pips, every 10 pips, I'll give it a red dot. If it moves higher 10 pips, every 10 pips, I'll give it a green dot. If it moves 10 pips, then comes back 10 pips, I'll give it a blue dot. If it moves 10 pips down and back up 10 pips, I'll give it another blue dot. That's just like a pause, a hold of a level, an indication that markets may continue to reverse in the opposite direction. It's very important that you have this type of move, which is like a neutral or a return move, and not always count everything as a 10 green and red dot, right? And later on, when you actually look at the MOTS grid, it'll make sense. And then, like I was explaining, if it moves 18 pips or it ranges between 10 pips without traveling a distance of 10 pips, we'll give it a white dot if it just do all types of bullshit within an hour, which means that it just held the level as well. All right, and that's all explained in detail in the previous videos in the MOTS grid. And then I kind of explain MOTS analysis, which is how we interpret these dots on the screen. The MOTS analysis is a way to see how price travels from point A to point B, and from open to close within a structured mathematical framework that makes sense of market movement. So what I mean by that is markets don't go straight up and they don't go straight down. The zigzag moves that market does, the bullish and bearish move that market does, have to be tracked as well, because it gives context to what that range is. That's how you understand markets move 18 pips without traveling 10 pips or more in one given direction. And then the way that it happens, so it could go high, low, high, low, 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 high, low, low, and then all of that data together is going to give you the summation of what happened within the hour, the sequence that it happened. Did it go high first, or did it go low first? Did it go low first, or did it go high first? How many highs, how many lows, and what way did the zigzag happen? So that would just be, instead of just saying, oh, we moved 10 pips, or oh, we moved 100 pips, you would know how we moved 100 pips. We moved 10 pips, then we came back down 40 pips, then we went back up 60 pips. That's when you get the context of how markets move. So it's just really explaining how markets get from point A to point B, because they just don't go straight up and they don't go straight down. And when you do that, that helps you get into the structure of the markets on a mathematical level. You get what I'm saying? Not on a subjective level where, okay, I can look at if I hate this phrase, right? If market's doing like this, it's bullish. Jesus Christ. If market's going like this, it's bearish. If market's doing like that, it's consolidation. You tell that to somebody that don't know the markets, they're going to get confused. They're obviously going to get confused, because it's a subjective way of explaining it. You need a non-subjective way of explaining it where everybody can come to an agreement that this is consolidation. This is an uptrend. This is a downtrend. And since markets is expressed only in math and price and time, it doesn't know what higher. It kind of does know, but you know what I mean. There's no abstract construct of a uptrend and a downtrend. There's a mathematical construct of an uptrend and a downtrend. Computers do not speak English; they speak numbers. So that's beyond the point. And then let's move on to the next slide. And then using that same framework, we have trade setup. So using the same framework can be used to build trades. Each level acts as a data point and a decision point. When you place your entry on a level, your stop loss and take profit can be proportionally spaced around it. As price reaches a level, the behavior of past price action at that point provides the context to make an informed trading decision or projection for what may happen next. All right, let's break this down. So each level acts as a data point and a decision point, right? So the grid before, right, was just giving us level 1, level 0, which is where we opened at. We got the level plus 1, which is 10 pips above the open. You have level -1, which is 10 pips below the open. And the levels can go into infinity. Level 2, 3, 4, 5, 6, 20, 30, 40, 50, 60 pips. And the same thing, bearish 10, 20, 30, 40, 50, 60 pips. Level 1, 2, 3, 4, 5. Level -1, 2, 3, 4, 5, and 6. So on and etc. Right? But the same lines can be used to build your trades. So now, as you can see, the candle open price could be the entry, the candle open level and price. So you got level and price are going to be used interchangeably with this lecture, right? The level can you be the entry, and guess what? 10 pips above the 8 candle, the candle open price and time and level is going to be 10 pips up here, which could be your TP. And then guess what? Proportionately, you can have a 10 pip stop loss if you have if this is a buy trade, right? Your stop loss is going to be proportionally 10 pips below. And then this could be used for multiple levels. You could set your level, your TP 30 pips above, but it'll also fall on level L+3. You can put your stop loss 20 pips below. And then you could flip it around where if you are on a sell position, your TP will be right here, and then your stop loss will be up here, but the levels don't change. The value of the levels don't change. The distance of the levels don't change. It's just literally think about, how can you say it? Like the framework is like the best way that I could think about. Like it's just the framework that you could use to build your trades instead of trying to randomly put it at different levels, and your stop loss is 13 pips. Now to get a 2-to-1, you need 26 pips, and you don't know if Marcus is even gonna give you 26 pips. Then you look at structure and you believe that Marcus these are abstract thoughts. Marcus have to return to structure. It has to pivot off structure. It has to break through structure, which it does not have to. Marcus don't have to do anything that you want it to do. You get what I'm saying? But if you use this, I will also say just ease of use. If you already using the levels to explain to you how Marcus is traveling through time, how Marcus is into the way that it's traveling, the distance that it's traveling, why not put your trades on it? Why not say, okay, when Marcus has reached this level, this is where I'm going to enter to the trade. And because this is where I enter the trade and all my levels are proportionate, I will know where my TP has to be. Whether it be a risk reward unit, or let me not get too deep. Let's go on to the next one, right? So the same framework, once again, we're using the same framework. You see a rectangle and you see lines. You see price, you see time. The same level, and you seen entry, stop loss, and take profit. You've seen level +1, 10 pips, level -1 and -10 pips, and now you see coordinates. So when placing a trade, coordinates or price points, or the price that you enter into MT5 or TradingView, whatever you use as a terminal. So the exact coordinates, your entry, stop loss, or target price are already defined by the level itself. Simply hover your mouse or crosshairs over the level and record the price. This is your mouse, or you can click the button that your crosshairs. Let me show you. Crosshairs is, if you don't know what a crosshairs is, this is your crosshairs. You hover it over price, or you hover over the level, and the level already tell you the price that you need to enter. If the black line is my entry, the green line is my stop loss. As you can see, these lines are highlighted. I don't have to do any looking. I don't have to do any mathematical calculations. All I gotta do is look at the level. This is level. I know it's 10 pips above the 8 a.m. candle open price. What is if this is my take profit, what's the number? The number's already provided for you. Just ease of use. Everything falls right in line. Easy to use. That's what I mean. So the coordinates. So 10 pips above, 10 pips on Euro USD is 0.001. You add 0.001 to the entry price, gives you 1.12445 if the entry was 1.12345. I just put some stupid ass number, right? So basically, if you were doing it, let's say, like I'll give you the example. If you have some abstract number or some odd number, like and mine stop has to be 23 pips or below, you have to go on your calculator and go, what's my entry at? You have to subtract 23 pips, and then you figure it out. God forbid you press a number wrong. God forbid you do the calculation wrong, and now your trade's messed up. And then you have to, now I got to do like, what's a 3 to 1 now? Now I have to times 13 by 3, and then that's going to give me 39. Now I have to add 39 pips. By the time you do all that, entry's gone. The best entry's gone. Unless you have an EA, and then the EA is doing these mathematical calculations automatically. You get what I'm saying? This is very important. So not only is the levels there to track price action as it moves across time, and you could build trades off it, which your entry, stop loss, and take profit can be theorized using the levels. The exact price points that you need to enter into MT5 or TradingView, which is your trading terminal, is also there in the grid, right? That's what you call all-in-one, right? And then the next slide is risk reward. I touched on it a little bit, right? So when calculating or projecting risk reward, profit and loss or risk reward is also calculable in the framework. Each grid level represents a unit of movement, and every unit can be translated into your potential risk to reward, depending on the dollar value lots and position size, the range in pips, specific to your trade. So let me touch on this. Let me get a sip right quick. Sorry about that. So when the important thing about me with the grid was, it had to be universe. I can't want to talk about that too much, right? But the unit of risk, like now you understand, all right, the dramatization we use, the example we use is, this is our entry, right? If you get into a trade, whatever risk you have, automatically you could project a one reward. So if I'm risking $10 on 10 pips, then my reward will be $10 on 10 pips, which is the same stop loss, the same coordinate, the same TP, the same coordinate, the same entry, the same coordinate, risk reward implemented. If I want a 3 to 1, I'll just go to level 3, which is gonna give me 30 pips, which is gonna give me the exact TP that I need. If I want to make my stop loss a little bit bigger to 20 pips, I'll just go to level negative 1.2 or whatever level that I'm on. Go down 2 levels. Figure out where the coordinates is. I have a 20 pip stop loss, so on and etc. You get what I'm saying? And then you just thinking about price action in units. So for each unit of risk is the reward. Like I said, if I have my stop loss at a certain level, I'll easily be able to figure out where my take profit is, what level it is at. And the more advanced you get, you don't need to use the levels, but it's just a framework, right? But just the blueprint. And then because we're using units, and we could just say, okay, between these 2 levels is 10 pips, and that's where my risk is, then you could make it customizable to you, which is, all right, now what's my lot size? Because this is 10 pips, based on my personal account or your personal account, you can convert that. You get what I'm saying? You can convert it. 10 pips. If, like I said, I'm risking $1 a pip. $1 a pip is going to be a 0.1 lot. My pips, or the size of my position, is going to be 10 pips. So 0.1 lot times 10 pips is going to give me $10. $1 a pip. And then yeah, basically the math is already in there. I'm telling you, the math is in there. It's all math. Everything is gonna be just fall right in place perfectly for you to go ahead and not worry about all the other stuff. Dang, I have to learn this, I have to learn that, I have to learn this. No, once you learn the grid and you learn analysis, while you're learning analysis, you're learning trading, because it's all interchangeable. Let me go ahead and update the current grid. All right, let's go ahead and do this right here. So I don't want you to get confused. What you see here is gonna be the grid, right? Now I overlapped it with a new form of with my trading analysis or my trading dramatization, since I'm not in the trade. And I'm just going to build it up a little bit, and I'll explain it to you, because this is real time. You get what I'm saying? Nothing's better than getting off of a dramatization or example and then seeing it in real time. 6007. My bad, I had a brain fart right there. I gotta change. Actually, gotta change the title of this one right here. Me, I like to do the math. I just like math sometimes. Not all the time. Sometimes I hate math. But all the levels are here. I don't have to go ahead and do it in my head. You see? 1.16007. It's already there. So don't really have to do all that. And then usually when we hit a level, I project the next one forward, because I don't need to wait. It's within a range, so price action is traveling. I don't think of price action traveling pip by pip. I think of price action traveling in ranges. That's why I use the levels, ranges of 10 pips. So I just project the next level while we at it. So when it does hit it, I could just draw that as well. So as you see, this is my trading range. This is not my analysis. This is my trading grid. This is not my analysis grid. Once I'm done with the trading grid, I just delete it, and then I'll finish the grid unbiased to the trade. Because you have to understand, when you're trading, that's when you're looking at the chart with a trading bias, not an emotional bias, not a personal bias, but a trading bias. And then I'll go ahead and copy this hourly candle. Since we're at 9 a.m., the 8 a.m. to 9 a.m. candle is done. I can go ahead and analyze how it moved. You know what? I have to go ahead and make my original grid larger. This is going to be L plus 4. And you already know that's 40 pips above the weekly open price for this one right here. I gotta figure out what the L plus 3 was. Then I can go ahead and add 10 pips to what the previous level was. 951. Shoot. 951. There we go. Copy that. Paste that. And we have that. Let's go ahead and do it one more. We probably gotta do it 2 more times. Maybe one more time. L plus 5, 50 pips above the weekly candle open price. Paste that. Turn that to 60. Copy. Paste. And probably move. I probably gotta move the daily. Daily range higher. Yeah, like I said, we do have to do 2 because it did touch that. Alright, one more second, guys. One more second. And then I'm gonna get to the point where I have a computer, I have a script that generates the grid for me, where I don't have to manually do it. But think of us at prehistoric days. Alright. Bring that up some. So this is my daily grid. This is my trading grid. It's overlapping. It's one on top of each other. So sorry for any confusion. The more you learn it, the more you be able to understand and see it. But you, at least you know in the back of your head, it's all based mathematically. It's all proportional. It's all even. It's all based off of raw data, which is price and time. And then as you can see, we got our first 10 pips. Then we got our next 10 pips. Then we got our next 10 pips. So in the 8 a.m. candle, from 8 a.m. to 9 a.m., price moved for little to no drawdown, which is basically no drawdown on the other chart. Little to no drawdown, 10, 20, 30 pips bullish. 1 to 3 if you had your stop loss down here. Probably if you had a 5 pip trade, it's gonna be 1, 3, 5 to 1. And that's the trade for the day. You don't even need to trade anymore on one trade. I'm learning. I'm gonna figure out how to get these better risk reward trades, but I'm not doing that right now. And then I'm gonna let the next day do what it do, and then we're gonna continue analyzing at that. So let's get back to PowerPoint. All right, so that bit I basically finished covered what risk reward is, right? So next, all markets, one logic. So using this beautiful building block of price and time, whether you use it for hourly candle, whether you use it for a daily candle, whether you use it for a weekly grid or candle, all interchangeable. 1 minute, 5 minute, it's all this rectangle. This rectangle is all you need, but the context is the rectangle is what's most important. They try to fool you and let you think that, okay, go on this chart, the hourly chart, go on the 4-hourly chart. You're not, and you think that you're looking at time. You're not really looking at time. You have to look at that time and price action. You have to look at the context of the candle in reference to a higher time frame. That's why they try to do 4 hour, 1 hour. But when you visually see the framework, it's a lot better than imagining and all this other stuff, and it's a lot more accurate, it's a lot more proportionate, and it actually lets you understand what's really happening, because it's going to unlock your brain to the reality of the real structure, the real harmony of the markets, and the real laws that the markets have to follow. Instead of believing that it's all this irrational movement, you'll understand that it's more harmonic, structured, intentional type of movement, right? So all markets, one logic, coming back to the one. And most importantly, the entire framework and all use cases is universally applicable to any financial instrument or security displayed on a chart. So whether it's Forex, whether it's gold, whether it's stocks, whether it's crypto, all use the same framework. All can use the Magnum Opus trading grid. All can use the Magnum Opus trading logic. You can use it for analysis. You can use it for trading. Or you just have to make it customized. You just have to customize it to the security, because some securities you move like your USD. They don't move in pips. They might use them moving points. They might have higher pip ranges where like you can say gold is like 10 times. So for every 10 pips in your USD, gold probably moves 100 pips. You get what I'm saying? So you got to figure out the characteristics. First, you just got to figure out. No, first you apply the grid in this. It doesn't matter. You apply the grid. Price and time is going to stay the same. You apply the grid on any financial instrument or security that you want. Then you learn the characteristics, because the framework of the Magnum Opus trading grid is going to present you the data the way that you want to see. What is the minimum average size of an hour? What's the minimum average size of a day? A week in price action. Then you could put it into context. Then you could figure out, how does this market move from point A to point B. But time and price is going to be, whether it's on TradingView, MT5, Thinkorswim, the principles remain the same. Every chart expresses data through price and time. So the hour is always going to be an hour on every chart. A day is always going to, not necessarily. Time is always going to be time on a chart. So you got, because I know gold closes at like 5 to 6 o'clock. So you lose an hour. So instead of a 23-hour trading day, instead of a 24-hour trading day, you have a 23-hour trading day. But the hour, that's why I say the hour is the most important, because they can manipulate a little bit about the day and the week. But regardless, for the most part, the grid stays the same, and it can be used on any security. What other strategy, what other system, what other thing that you know could be applied across everything? They probably give you a gold strategy. They'll probably give you a way to look at Forex. Probably give you a way to look at a commodity. Then you go to, once you get the stocks, you on your own. You got to find somebody else that do that knows stocks and whatever. Not to say that the same thing doesn't technically apply to the grid, but the logic is can be applied to filter. and then you learn the characteristics of the instrument or the security that you're using, and then you could build whatever you want to build based off of that, because at the end of the day, it all operates on price and time. And the Magnum Opus trading framework is designed to interpret and trade that relationship consistently across all all platforms. So whether you're using MT5, TradingView, Thinkorswim, it's still going to be coordinates, entries, exits, price points, and you can get that off of the grid. And that's very important to me, because when you start studying math, when you start studying mathematics, when you start studying price and time, you realize that it's the same thing across everything. You shouldn't be having one logic that only works for one thing if you're trading, or if you're doing technical analysis. It's just numbers. So the same way that the computer expresses the markets, the same way that you should understand the markets. Not with these double tops, double bottoms, and harmonic patterns. Harmonic patterns actually do have mathematical implications to them, so I don't want to discredit them or anything like that. But just when it comes to like these complex things and these abstract occurrences that they're not applicable everywhere. You want something that's applicable everywhere, and what's applicable everywhere is price and time. All right, this is where I think I'm still working on these slides, and then I have some more slides to work on, but we're gonna go on. We're gonna go. So here's another truth, and I'm gonna keep on hitting you with facts, straight facts. Price can only move up or down. If you didn't think it was that simple, I'm gonna make it simpler for you. That's it. The same price action that everybody complicates and argues about is as simple as time, which only moves forward. So time only moves forward. It can be read backwards. It can be read historically and whatever like that, but it only moves forward. Price action can move up or down. And then the complicated movements of both up and down movements is going to be referred to as price action. So price action is the collective sum of these two movements through time. Price action is only definable when you look at it in reference to time. If you don't look at it in reference to time, then it's really hard to define what price action is, what the range is, what it's doing, what it's done, so on, etc. So you have to put in reference to time to really understand price action. But price action is going to be just the up and down movements of markets, because markets can move both up and down at any point in time. Price doesn't shoot straight up to its destination. It fluctuates, it rallies, it pauses, it reverses, but it must travel through time. I talked about that. Though it may seem chaotic, we've already proven that what you see isn't always the truth. I'm trying to break down those mental concepts and what you've learned and what you believe and what you perceive in the markets. Once you understand, once you start at the starting point that what I'm seeing is being filtered by my mind, my emotions, my perception of reality in this moment, you will understand that you're actually not seeing the markets for as it is. But if you put it into the grid, whether your emotions, your circumstances, your situation changes, which it will always, the data doesn't. Once the data is printed, it's permanent. And when you have a framework that allows you to read price action that way, it's going to help you to see it as that. Not to say that's going to always stop you from doing bad things or negative things or perceiving markets the wrong way. But at that point, you will be able to identify, I messed up. I want to say the F word, but I'll try not to. So that's important. So, then, all right, now next is remember, it doesn't have to make sense. Price action that you see on chart, the wiggle, waggle, wobbly whoop that's going on, it don't have to make sense to you, but it must make dollars to somebody else. So even though as a retail brokers, so because whether you're a retail trader or a high frequency algorithm, one thing remains constant, which is profit. We're all in the markets to make money. So it doesn't matter if it does, what the hell is the markets doing? What is it doing here? What is it doing there? It don't matter. Whoever's moving the markets is in there to make money. And to make money, you have to bring markets from point A to point B. Now, when it comes to big hedge funds, traders, and everything like that, they can move markets against their own interests temporarily, but sooner or later they have to move markets in their interest to make their money and get out the markets. So they can have a negative balance or a negative hit, it's not a loss until they close, negative equity move or whatever like that. And they can move markets against themselves to gather trades, to give them better entries for scale in, all types of things. But at the end of the day, they have to produce a profit. It might not be today, it might not be on that trade, but sooner or later, the intention is to make profits, whether it's us or the people moving the markets. Price has to get from point A to point B, and it has to do that in a set amount of time. And we're all in this reality bound by time, which is still a mental concept, and we're not actually bound by time. Yeah, time is infinite. But in regards to trading, that's what we're gonna go with, right? Let's go to core price action moves. Core price action moves. What I would say about that? There are only 4 movements price can make. Theoretically speaking, I want to break it down to the simplest forms, but as advanced, if you're an advanced trader, you get where I'm coming from with this. The 4 main or true movements price can make is from the open up, from the open down, from the open up then back down, from the open down then back up. Everything else you see on chart is a variation or a distortion or a combination of these 4 movements. If you understand first these 4 core movements, it will help you understand the more complex movements that and the different variation these movements can happen in. But you first must understand markets can just move. If markets is gonna move up past the open, markets can move down past the open. Markets can move up, pivot back, and go down. Markets can start down, pivot back, and move up. This is where you get into sequences where it starts one way, changes the other way. It could change directions a few times. It could cross the open a few times. But at the end of the day, these are the 4 movements. It's just a complication. So you can start with 1 up or down. Then you start with 2 down and up. Then you could go to 3, 4, 5, 6, depending on the time frame, depending on the price action. But it all is just a combination of these core movements. And when you understand that these are the core movements that market's moving, it'll be easier to analyze it. It'll be easier to trade it. Might not really click for you right now, but it's gonna click later. So master these movements and you begin to see the markets for what it truly is. Not chaos, but rhythm. Now, if markets can only do is actually these 2 movements, and I just add this complex movement because you have time in it, so time can allow more than 1 movement, which is the 2 main movements, in 1 time frame, which is the square, which is an hour, day, week, whatever. What I was going to. Now you understand all of these wiggly waggly confusing movements really just come from the only 2 movement markets can make, which is up and down, or a combination of the 2 movements markets can make, which is a combination of up and down movements across time, past the open to the close. Let me take a sip. That scissor. Now, you combine that idea with this, the core trade executions. There are 3 ways to enter a market, a trade, I mean. There are 3 ways to enter a trade, 3 main ways. You have a market execution. You buy or sell at the exact time and price you press the button. A market execution is an example like I click new order. You go on your phone, you can click new order, or you can have that little thing at the top which is flashing red and blue, red and green, and you could press it, which allows you to enter the market at a push of a button at the exact time and exact price you push that button. That's a market execution. I want to get in now, and I want to get the price, the best price that you can offer me, the broker will offer you now, right? That's how you can get in. That's one way you can get into the markets. I don't know why I closed it. The next way is with pending stops. You enter when price crosses a level or price to continue in that direction. Buy stops is above, sell stops is below. So these are pending orders. Pending orders means that, go over here, you go pending orders, same, probably a little bit different on MT5, the app and stuff like that, or your platform that you're using. But technically, pending orders are, I'm not going to get into markets right now, but I know what price or time that I want to get into the markets. But it's now the markets want to order, the terminal wants to know, how do you want to enter into the trade, or what do you expect markets are going to do when it reaches that price point that you're using. So if I want to get into a buy stop, which is what I'm looking at, depending, first one I'm looking at stops, right? Pending stop, right? I'm expecting price, let's say I use this level right here. If I'm entering, thank you for the like. If I'm entering to a buy stop, I expect price to go to this level and continue past this level, right? So this is like, all right, price is at a certain level. I'm going to set the stop above that level, and I expect price to continue past that level, right? And that'll be my entry. I have my stop loss down here. I have my take profit up here as an example, right? And then the same thing with a sell stop, right? Let's say price is going to be moving down. I'm going to put my stop loss. I'm going to put my sell stop at this level. Price is going to continue down, touch this level, enter me into the trade, and I expect it to continue going lower. I'll put my stop loss back here, and then I'll put my take profit down here. So a stop actually means continue. I don't know why it's kind of confusing. I was very confused with buy stops and limits for a long time. But just think of when it says stops, think of breakout or continue past the price that you predefine. And the buy stops and the sell stops, it's not like market execution. You don't get into it right now. You have to place it and then wait for price to hit that level or the price that you choose, and then it allows you to put your stop loss and take profit in the trade as well. So once price triggers the trade, it'll automatically have a stop loss and take profit within it, whether it's a buy or sell. Then the next pending order is going to be a pending limits. The limits is easily the same. I can't even say the same process. It's a slightly different process, but it's for you. Let's use the same buy level right here, right? If you're expecting price to get to this level, but instead of going past the level and continuing, you expect it to pivot, like right here. Pivot on the level and continue going lower. So let's say I put my my sell limit. Now it's flipped. So instead of putting a buy stop above, you're gonna put a sell stop above, because you're thinking market's gonna go down bearish to sell, but you're waiting for price to continue forward first and then go down to buy. Now I'm gonna think about what I'm saying here. You want price to go up first and then down. So instead of going straight up and straight down, now you want markets to go up and then down, or you want markets to go down and then up in terms of a buy stop, which is what I would have placed today if markets, which I would have placed on a day that didn't have a holiday, right? It's just for a pivot. So you know where markets is at, where markets is currently at. You know what direction markets is gonna go, and you know markets is not gonna go past that direction for the area of your stop loss, and you think it's going to continue in the opposite direction. You think that's the furthest market's going to go, and go the opposite. So the sell stop is going to be above, and then the buy stop is going to be below, and that's also in here. Limit. The sell limit is going to be above, and then the buy limit is going to be below. But you got to read this, because I'm going to get tongue-tied saying these things, but read it a few times. For me, I had to read it, I had to draw it, and I had to watch YouTube videos for it to really stick in my brain. But listen to what I'm saying here, because I'm going to bring it all together. Now that we have the framework of how you get into the trade, the use cases, and understanding about how price action moves, we can finally apply trade logic, the bridge between data and decision. So, where motion, which is price action, meets method, which is trade entry. If we compare core price action movements, if we compare these main movements, above, straight up, below, straight down, a combination of the two, straight forward, then straight down, or straight down, then straight up. If we compare the core price movements to the core trade executions, I really want you to look at these two. Market execution, you could just think of it like if I'm trading at a specific time, like I want to get in exactly at 8 o'clock, or I want to get in at, that's probably closer to that. Or if you're a more experienced trader and you just know how to get into a better trade with instant execution, or market execution, then you use that. But we're focused on these two pending limits, where we allow price to get to the we allow price to put us into the trade instead of getting into the trade ourselves, which eliminates a lot of bias, right? These are the trade executions. You can see that the way the markets move and the method it enters in at are perfectly aligned. So that's what I was trying to say, right? Let's go back to the core moves. Remember, this is the 4 ways markets can move, but this is also how you get into a buy stop. If I don't think markets are gonna move bullish and continue bullish, you put a buy stop above the open price and it goes there. If I think markets are gonna move bearish and continue bearish, you put a sell stop below the open or the level, and I believe markets are gonna go straight through there. Now, if I want to get into a sell limit, I think markets are gonna go up first and then pivot and then go back down. So I'll put a sell limit at this level for it to pivot and then go back down. If I think markets is going to go bullish, but I think it's gonna sell first or go down first and then pivot and go back up, I'll put a buy limit below the open. And look at that. Before I even spoke about the executions, I spoke about the core movements. And now the core movements exactly correlate to the core executions. It falls right into each other, and now we're speaking of it in reference to the trading grids. You got your opens, you got your levels, you got your market movements, you got your trade executions, you got your strikes, you got your distances and ranges, which are proportionate, you got your potential entries, you got your potential take profits, you got your potential stop losses, you got your coordinates that lay on the levels. You could put that into risk reward. I'm telling you, you have to ask yourself at this point, how is everything tying in so perfectly? When price action, price and time, price movements, trade execution, the levels, the distances between the levels, risk reward, all of that, and time, where it starts and stops, range, all of that it just all falls so perfectly together. It works so much in harmony. You have to ask yourself, why? Why does it do that? It can't be possible that the trade logic and how markets move, even though it's irrational, when I put it in the grid, it fits so perfectly. Because it only uses price and time. It only uses mathematics. If you stick to the pure data and you don't look for money, if you stop chasing money and you start chasing information, this stuff will be revealed to you. I didn't create any of this stuff. None of this stuff is new to the markets. None of this stuff is a new design or a new creation or a I don't know what the word I'm going to use, right? It's there. It's always been there. It's your perception of it, your understanding of it, how you use it, that wasn't there. If you're just looking for money, you're looking for up movement, you're looking for a down movement, you're looking for a buy trade, you're looking for a sell trade. But when you're looking for information is looking for you, and then it's just gonna be so perfect. It's gonna fall so perfectly aligned. Let me see. I think I basically explained it. Each method aligned perfectly. All right, breakouts, reversal. The motion and the method fit hand in hand. All right. All right. Now, the odds are in your favor. Stop. Even though market makers, your broker, accessible information and everything and everybody tries to put the markets against you, try to make it seem like 90% of failure, 90% of traders all fail, try to discourage you, trading is hard, it's complicated, everybody loses, the markets isn't up, we're in a depression, we're in a recession, crypto is fake, the markets are gonna crash. it doesn't, as much as people try to put the markets against you, try to put the odds against you, they're actually statistically in your favor. Not opinionated. It's not my opinion that's in your favor. Statistically speaking, it's in your favor relative, right? I still gotta put a little asterisk in there, relatively. Alright, now think about it like this. Let's go back down, let's do a quick summary. Every trade begins with an hour. Remember when I said that? It doesn't matter when you place a trade. You can look at the time that you place the trade, what hour it is. Every trade, whether it's a scalp day trade, investment, swing trade, it has to happen within the hour. The minutes, the seconds all happen within the hour, and it builds over the days, weeks, but it must occur within an hour. So every trade begins within an hour. That's the first point. Every hour only allows a limited number of possible price movements. It only can go up and down, or a combination of the both. And every trade can only be entered in one of three ways: market execution, or more importantly, pending limits and pending stops. So the odds of entering in the right trade at the right time in the right direction are not as improbable as you have been led to believe. In fact, it's more probable than gambling in the casino, betting on sports, or even playing the lottery combined. Not even separately, combined. How many hours in a day? 24 hours. Let's speak about Forex right now. 24 hours. How many hours in a Forex trading week? 120 hours. Let's say you have the trade of the week where you got the best entry for the beginning of the week all the way throughout to the like you scalp, like you got a perfect entry, sniper entry, and you got a perfect exit at your TP for, let's call it 100 pips. 100 pip trade from the top to the bottom clean. That the buy or the sell position happened within an hour. And there's only 120 hours within the trading day. So you have first you start off with a 1 out of 120 chance, right? Even if you do the Madden Opus grid on your USD and you have a range of 10 pips, you still get like a 1 on 120. Then you got to divide that by two directions. You got multiply by two directions, bullish and bearish. What is that? 240, 1 and 240. And then we got to multiply that by what? Price movements for you multiply that by types of ways you get into the trade. I'm pretty sure that's not a real calculation. I know it ain't 1 in a million, 1 in a quadrillion like you get in the casino. Maybe not blackjack and baccarat, which is still higher. But then you have sports betting, which is you're betting on human beings. One of the worst bets you ever take. Or playing the lottery, which is like 1 in a quadrillion, right? And when I combine it, it just makes the number even bigger. So your odds in trading is a lot better. The odds of you actually, now that's on a perfect trade. Let's talk about just getting into profits. You're technically at a closer to 50-50 chance. There's only two direction marks can go, a buyer and a sell. You get in a buy or sell, sooner or later, it's not going to be the profit if you don't predefine your profit. If you go up $1, you've won. You've technically won. You let that trade depend on the trade. You let that trade, leave that trade open long enough, you might go into profit. The odds of you getting the profit is actually higher. It's the fact of you getting out of the trade is going to be the hard part. So the odds of you actually creating profit is high. The skill is being consistently profitable and not just randomly gambling or randomly betting on the direction, right? But just to give you a little more assurance that the probabilities of you getting into the right trade with the right information and logic and the right discipline and the right risk management and trade management parameters, you're basically stacking the odds back in your favor using historical data. All right, next is when to strike. Now we're going to try to put some confluence together as to why I'm getting into the trade at what hour, right? So find the right hour or level to get into the trade. Even with better odds, success still depends on timing. On the using the magnet open trading grid, we study hourly candles to identify high probability movements. So what do I mean by that? So I could go ahead and try to just show you a real chart while we at it. I can just use this chart actually, right? And we look at, so this is day 2. The days on Forex start at 5 p.m., 6, 7, 8, 9, 10, 11, 12, 13, 14, well, not 13, 14, 1, 2, 3, 1 p.m., 1 a.m., 2 a.m., 3 a.m., 4 a.m., 5 a.m., 6 a.m., 7 a.m., 8 a.m., right? All right, so this is the magnet opens grid on today, which is Tuesday, November 11th, right? What happens is when you identify each hour within the framework of the magnet opens trading grid, you will notice some hours consistently have a low range, and they usually fall in the same hour consistently. Like you could just say I'll say the first 8 hours of the trading day from 5 p.m. to 12 a.m. around that time, you really don't get no movement happening in price. And it consistently happens. You start noticing a pattern. Now, sometimes there is movement there, but you're not going to let that. You still have to think in probabilities. Some days there might be movement in there, but on a range of 365 days, what's the odds of there being movement? Less likely than it is, right? Then you will notice that it's going to be what we call consistently certain hours of the day have more movements. Look at this, 8 o'clock. We went all these hours where we didn't go more than 10 pips in each hour, right? And then in one single hour, we went 30 pips or more. And then we're probably going to continue going more throughout that little time period, right? But it's not like saying, oh, I think, or I feel, or I've guessed. Over time, consistently, you will notice the differences between hours. Some hours have more range than most. And that's a fact, right? I don't want to go too deep into it. I'd rather read it first, but. And then the best hours, and then you could align what hours have more volatility to trading sessions. So the first trading session or the high trading session will be like London, which is from 1 a.m. I say it's from 1 a.m. to 4 a.m. They have probably like a different quote of the time, but in my experience, I want to keep it between a 4-hour window of the highest volatility. The most probable times it's going to happen is from 1 a.m. to 4 a.m. And then you have the New York session, which is what I trade, is from 8 a.m. to 12 p.m. What you also want to realize when you're looking for these high probability or the times that align with high volatility is that, am I going to realistically be awake to trade it? So London sessions don't really apply to me because I'm not awake I'm not awake and I'm not going to be awake at that time. Fortunately, we have New York session, which is 8 to 12, which I can be awake, and I will be present to take trades and manage trades and close trades at or after that time. And you have such session crossover where London is, like I said, it's not really from 1 a.m. to 4 a.m. It crosses over New York session. Like it's still their session is still open at 8 a.m., 9 a.m. and stuff like that. So they overlap each other. So it gives you better volatility. So London people are trading, New York people are trading. More volatility is gonna happen. So a bigger range. So potentially a bigger trade. I'm not wooed. I'm not excited by high trading ranges. I'm excited by consistent ranges. So instead of looking for 100 pips all the time, I'm looking for 20 pips because I'm looking for what's more probable, what's possible. Is it possible to go to 100 pips, 200, 300 pips? It's possible. Is it probable every day to go ahead and get that 100 pip, 200, 300 pip move? No, the hell it ain't. So if I want to consistently get in and get out of the markets, I want that 20 pip range. And if markets give me more, I have a trading stop method that allows me to do so. If market doesn't, I'm content with that range because it's going to happen every day. It's going to fill my psychological needs to trade every day. I don't trade every day anymore because the more you trade, the more you advance as a trader. You don't need to do certain things, but you've trained yourself beyond that point. So I wouldn't say you jump into swing trading or jump into investing because you don't have the patience for that yet. But But yeah, what else was I gonna say about that? Yeah, now I don't have to trade. I don't have to take a trade every day, and now I am looking for trades larger than 20 pips because I'm not trading every day. I'm gonna need a bigger risk reward. So it's just the gradual. I respect I respect the journey. I respect the grind. Where I've mastered that 20 pip range already. Now I already know, okay, I mastered 20 pip range, and while mastering 20 pip range, I've noticed 50 to 100 pip ranges that I can now monopolize on because I've seen it happen 100 times, more than 100 times, I can tell you that much. And now I can hold trades for a day or two. You get what I'm saying? And then I'll be like, all right, I mastered the 100 pip range. Now I could hold it for a week, or I could hold it for a month, and then I could catch bigger ranges because my entries are going to be more precise. My discipline is going to be a lot better, and just not jumping, chasing the money, right? Chasing the data. You could also trade at the day's extreme for the largest range, or at the start of the day for the most time. So you don't always have to look for the hour, right? So it's just a caveat I threw in there where, yeah, you could look for the biggest hours in trade and place your trades around those times or at those times. But then again, you could trade, like I said, you could trade at the range. Like, this is the furthest point of day 3. If I got into a buy position, I could have held it and then got the majority of the move of the entire week. These are the day extremes. The day extremes are going to coincide with the weekly extremes, and the weekly extremes are going to give you the big moves. But you need a lot more patience. You probably going to lose a few trades before you get to it, and your risk reward, you're going to have to hold your trade longer, and that comes with experience. But instead of looking at individual days, you can now look at individual hours. You can look at days and how they interact over the week, and you can hold trades longer to get bigger trades, which is possible. So instead of hours, you're looking at days, and then you can look at weeks, and you can build your way up from there. Or you can start at the day, where it's like, if I start my trading at 5 p.m., I get the full 24-hour day period to go through, and possibly get the bigger trade. Possibly, I don't have the statistical data as to that yet, or the method as to do it. I have the framework. The grid is always the framework, but I understand that, if I trade at 8 p.m., I only have 9. If I trade at 8 a.m., my bad, I only have 9 hours left in the day for my trade to develop. But if I trade at 5 p.m., I'll have 24 hours for my trade to develop. But because I've done enough study myself, sometimes, I can't say more often than not, but at times the trade happens within the New York session. Sometimes it happens or starts at the London session. But that 20 pip range that I'm looking for, that's the beginning of a trade that I'm looking for that I can trail further. Usually happens in that range, and I'm content with that. But there's different ways of monopolizing on the move, getting in and getting out of possibly profitable trades. I just had to throw that in there for you. Either way, let historical data confirm your decision. So either way, whether you're going to use the most volatile hours, whether you're going to use the extreme points of each day and week, which is going to be the pivot points, or whether you're going to just start your trade at the beginning of the day and allow the most amount of time to pass for you to higher odds of getting the furthest point of that day or of that week or of that period, you want to use historical data to what can I say? To confirm that decision, right? You want to use historical data to build a reason as to why I'm making this decision. What historical data? Yes, I've analyzed 2 years, which is probably like 600 days of 8 a.m. Volatility, and I know that 8 a.m. is going to be the best hour consistently on a probabilistic basis to have the biggest move. So my odds of getting a great trade at 8 a.m. is historically proven. Or I can be like, all right, if I trade London session, I can have that trade that I want consistently because I've used historical data. Or I can say, historically speaking, if I wait till a price to go 50 pips within the day, I can now start selling because I reached the day extreme. Or I can say if I use a 30 pip stop loss at the beginning of every trading day, I'll end up having the trade of the day every single day. Or not every single day, but I'll end up having that trade of the day on a probabilistic basis, right? Let's move on. The MOTS math game. Alright, I could read this, but this is probably like the last slide. This is where I have to explain to you guys how I'm probably gonna change this entire slide. This is where I'm gonna explain to you guys how to treat trading like a game, not to play with the markets now, but to treat trading like a math game, which is profit and loss, add, addition and subtraction, multiplication, point A to point B, getting tagged and tagged out. This is like a theory of how I'm gonna have this slide read. Think of trading as a simple visual game. As you can see, the MOTS grid is a visual explanation of markets, and you could think of it as a game. You're predicting how far and in which direction price will move without getting tagged out for a loss. Or you're trying to predict how far the distance in profit or the distance traveled markets are going to move before you get stopped out, or before markets hit your stop loss or reverse and hit your stop loss. The entry marks your starting point. You know, games all have starting points. Your goal at a specific price level or time. The name of the game is choosing the right moment, the right time, the right price, and the right direction using price action, historical data, and confluences as your guide. So this is going to be whatever your reason is for getting into the market at that time, at that price, and in that direction, probably should be most likely built off of what you understand or what you see in terms of price action, historically speaking, of the data that you collected, and confluences like you could start now using like support, resistance, and whatever confluence, volume, order blocks, or whatever confluence you want to use as to enter into the trade. Price moving in your direction increases your money meter. The more price moves in the direction of your trade, the more money you make. Price moving against you drains your money meter. Or, you know, when you're going against you, start losing some of the profits, you start going to drawdown, you start heading to your stop loss, right? If price hits your stop loss, you're out. Tag, you're it. Tag, you're broke. If it reaches your take profit, you win. You win for that day, you win for that trade, you win for that period, right? And for me, I gotta add in the thought process is really in one trade. I know people trade multiple trades, but it's still the same thing. No matter how much you break up the trades, it's still one position in all, or it's just the equity that you're using in your account balance. It doesn't matter if you're using different your exposure, I should say, that is available. So it doesn't matter what you got going on there. So I got those. Now I just gotta now I'm out of slides.